You're staring at your TradingView chart again. S&P is pushing into all-time highs, candlesticks grinding upward, but something feels off. Volume is thin, price is choppy, and yet your finger is hovering over the buy button like it's a trigger that can finally fix everything. You're down this week. Your funded account has $300 of profit left before you hit the payout target. Your brain keeps looping. One good setup, just one. If I catch one clean move, I'm back. You click in with full position size, tight stop loss, big take profit. 5 minutes later, you're stopped out on a tiny wick, price snaps back in your original direction, and you feel that hot flush of rage in your chest. You weren't trading the market, you were trading your need. In this video, I want to show you what a winning trader's mindset actually looks like in real time. Not motivational quotes, not believe in yourself fluff. The real internal wiring that keeps you alive when markets are slow, when we're at all-time highs, when conditions are low probability, and your brain is begging you to force trades anyway. Because here's the ugly truth. Most traders lose money. Even traders with good strategies and convincing back tests blow up because their mindset can't handle randomness, drawdowns, and boredom. If you don't fix that, no setup in the world can save you. This is not financial advice. This is survival advice. The first thing you have to understand about a winning trader's mindset is this. Trading is not a time-based job. You are not paid for screen time. You are paid for decisions. But your brain doesn't believe that. Every time you see your P&L flash green, you get a dopamine hit. Every time you are in a red position, you get a spike of cortisol and adrenaline. When the market suddenly moves, your heart rate jumps because your nervous system reads it as danger or reward. Layer that on top of Discord and Telegram, feeds full of other traders posting wins, and your mirror neurons light up. You feel like you're missing out on moves other people are catching. That's how you end up taking low-quality setups just to feel like you're doing something. Mark Douglas, in The Disciplined Trader and Trading in the Zone, talks about this exact trap. Most traders walk into the market with beliefs like, I have to win on this trade, or I'm close to passing my funded account. I can't take another loss. Those beliefs create fear, and fear narrows your perception. You stop seeing the market, you only see your need to be right. Brett Steenbarger, in The Psychology of Trading and Trading Psychology. 2. 0 adds another layer. He explains that performance breaks down when you become outcome obsessed instead of process obsessed. You start trading to reduce emotional pain instead of trading, because the setup across your timeframes is actually there. So what does that look like on a random Tuesday at all-time highs? You wake up. You see the index at record levels. There's no major news, no clear higher time frame structure, just sideways order flow and messy candlesticks. A winning trader looks at that and says, today the opportunity is not to make money. Today the opportunity is to protect capital, to work on patience, to execute small size, and to leave my ego out of it. A losing trader looks at the exact same chart and thinks, I need to hit my daily target. I need to grow my account. Then they zoom into a 1-minute time frame, hallucinate patterns that aren't really there, overtrade, and end the day in a deeper drawdown. Here's the paradox. The more you feel you need to make money today, the less likely you are to see the market clearly enough to actually do it. Now I want you to meet Marcus. Marcus is a risk manager. He trades index futures and major forex pairs intraday, focusing on a few clean setups a week. His edge isn't just in his model. His edge is in how little he's willing to risk when the odds aren't clearly in his favour. His desk has 3 monitors. On the first, he runs higher time frame structure, daily, 4-hour, 1-hour charts with levels and liquidity zones. On the second, his execution chart, 5-minute and 1-minute candlesticks with order flow and volume. On the third, he has his journal and a small window for news. Every morning, before he looks at a single candlestick, Marcus does something most traders never do. He labels the day. He asks, are we in expansion or in chop? Are we pushing into obvious liquidity like all-time highs or key support? Is there high-impact news on the calendar? Do I actually have conditions for my A setup, or is today a B or C day? On A days, Marcus allows himself normal position size. On B days, he cuts his size in half. On C days, slow range, low volume, Unpredictable price action. He either trades micro size or doesn't trade at all. This is a winning mindset. The willingness to let your size, your aggressiveness, and even your participation adapt to the market instead of forcing the market to adapt to your goals. But Marcus didn't start this way. When he first got a funded account, he was like everyone else. He watched that profit target like it was oxygen. If he was $400 away from payout, he'd instantly double his size. When he took a loss, cortisol hit, and he'd jump straight into a revenge trade just to get the P&L back to zero. Sometimes it worked, usually it didn't. And when it didn't, the drawdowns were brutal. One bad morning could erase 10 disciplined days. Then one afternoon, after back-to-back stop-outs in a choppy market at all-time highs, he closed his platform, opened his journal, and wrote one sentence: "I am trading to get funded, not to get good." That was his wake-up call. From that day, he rewired his approach using 3 rules that come straight out of Douglas, Steenbarger, and every painful market wizard story. Rule 1. Every day is a risk day, not a profit day. Marcus stopped setting daily profit goals. Instead, he defined a maximum loss per day and per week. Once he hit that number, he was done. No exceptions. If he hit -1R on the day, he cut his size. If he hit -2R, trading was over. Screens off. Walk away. At first, his ego hated this. His dopamine-hungry brain still wanted to get it back. But over a month, his worst days got smaller. His equity curve stopped looking like a heart monitor and started to smooth out. Rule 2. Expect to lose on every single trade. This one sounds crazy, but it's pure trading in the zone. Marcus started rehearsing the idea that every entry was just one of hundreds in a long series. Any single trade was random. His edge only showed up across a sample size, so when he clicked into a position, he'd say out loud, "This trade can lose and I'm fine with that." His stop loss was no longer the enemy, it was the cost of doing business. The result? His body stayed calmer. Less adrenaline, fewer cortisol spikes. He wasn't shocked when a trade didn't work because he had already emotionally accepted that outcome. Rule 3. If the market isn't giving you your model, you are not allowed to improvise. Marcus had a simple written checklist for his A setup: higher time frame bias, key level, liquidity sweep, reversal signal on his execution time frame, clear risk, reward. If 2 or 3 boxes were missing, it wasn't his setup, no matter how tempting the price action looked. Here's one of the biggest paradoxes in trading. The trades that feel the best emotionally, the breakouts everyone is talking about, the FOMO entries when price is already moving, are often the ones with the worst expectancy. The best trades are usually the ones that feel uncomfortable, going long when everyone in chat is scared, or short when the last candle just closed green. Layered on top of that, there's another paradox. The more you tighten your stops to reduce risk, the more likely you are to get wicked out over and over, growing your actual risk by triggering revenge trading and overtrading. Marcus saw this clearly when he started journaling properly. Not just outcomes, but context, volatility, market regime, his emotional state pre-trade, whether he moved his stop loss, whether he sized up impulsively. He realised his biggest losing days had almost nothing to do with his edge and everything to do with his state of mind. He'd move stops to give it a little more room, remove them entirely when price came close, or add to losers because it has to reverse here. That's not strategy. That's the dopamine system hijacking the steering wheel. So he built a rewiring routine. Before the open, he rated himself: sleep quality, stress outside trading, urge level to make it back. If those numbers were high, size came down. He didn't trust his brain with a full clip when it was emotional. During the session, after every trade, win or lose, he paused for 60 seconds. No new entries, no flipping bias. He'd write, did I follow the plan? Did I respect my stop? Was the setup really there, or was I trading my P&L? At the end of the day, he didn't ask, how much did I make? He asked, how much did I improve my process? Sometimes that improvement was as simple as, I walked away after 2 small losses instead of spiraling into 5. That's risk management. That's survival. Understand this, A winning trader's mindset is boring compared to the highlight reels you see online. It's not 10 trades a day with 10 different pairs on 10 different screens. It's a lot of waiting, a lot of watching, a lot of saying no to setups that are almost good enough. It's also brutally honest. Marcus had to admit hard truths to himself. I overtrade when I'm tired. I size up when I'm close to payout. I move my stops when I'm scared to be wrong. Once he saw those patterns, he treated them like any other trading pattern. They were signals. If his brain was screaming to take a trade, that was often the clearest sign he should not take it. Here's where the neuroscience ties everything together. Every time you override your plan, you move a stop, you add to a loser, you chase a candle. And it happens to work. Your brain gets a massive dopamine reward. It learns, ignoring my rules feels good and sometimes pays. That's how bad habits become hardwired. But the opposite is also true. Every time you feel the urge to violate your rules and you don't, you keep the stop in place, you reduce size, you close the platform. You're training a new circuit. Over time, your default reaction in stress becomes, follow the plan, not save my ego. That's a winning trader's mindset, not a lack of emotion. But emotional response is trained to align with risk management instead of fighting it. So what does this look like for you tomorrow? You sit down at the screens, you check higher time frame structure. Maybe we're still at all-time highs, grinding sideways with no clear catalyst. You label the day, probably C conditions. That means tiny size or no trading. Your job today is not to grow your account, it's to preserve capital and sharpen your eyes. You tell yourself out loud, I can go the entire day without a single entry, and it still counts as a win if I protect myself and follow my plan. You only allow yourself to take a setup if it matches your written model, not the model in your head, the one that's written down in your notebook with rules that survive backtesting and journaling. You set your stop loss before you enter. You calculate risk judged reward. You accept, before you click, that this R can be lost. You execute. Then you let the market do whatever it wants without begging it to validate you. You close the platform on time. You journal honestly. You rate the day not by P&L but by discipline. Some days you will still lose. Some weeks you will still be in drawdown. Past patterns never guarantee the future. But if you keep your losses controlled, if you protect your mental capital by not turning one red trade into 5, if you build the habit of only pressing size when your A setup is aligned across timeframes, you give yourself something most traders never have: the ability to still be here 5 years from now. That's the essence of a winning trader's mindset. Not, how fast can I get funded? Not, how do I pass this challenge by Friday? The real question is, how do I trade today in a way that the version of me 5 years from now would be proud of? Because if you build that trader, the one who respects risk, loves boring discipline, and understands that risk management is survival, the equity curve will follow. Maybe not today, maybe not this week. But over hundreds of trades, across bull markets, bear markets, and sideways ranges, that mindset is the only edge that never goes out of date. Most traders chase strategies, the ones who make it learn to build a mind that deserves to win. If you want to be in that second group, start with this simple rule tomorrow. Come to the market expecting to take no trade and expect every trade you do take to lose.